When it comes to building wealth, many investors in the UK, especially those interested in property, find themselves at a crossroads. Should they focus on investments that offer long-term appreciation, or should they prioritise immediate cash flow? The answer for most lies in investing for cash flow. This strategy not only provides consistent income, but also reduces risk, especially in volatile markets. In this video, we'll explore why investing for cash flow is so important, the various ways it can be achieved, and how it compares to investing for long-term appreciation. At its core, cash flow investing refers to acquiring assets that generate consistent, predictable income. This income can be reinvested to build more wealth, used to cover living expenses, or simply kept as a buffer against economic downturns. When it comes to property investing, cash flow usually means rental income, the money tenants pay to live in your property. When done right, investing for cash flow can offer immediate financial benefits, providing a steady stream of income month after month. So let's highlight the importance of cash flow. The primary benefit of cash flow investing is the generation of a stable income stream. Whether you're investing in property or dividend-paying stocks, the consistent cash flow of money can offer a sense of financial security. In the UK, where inflation and interest rates can fluctuate, relying on assets that produce regular cash inflows gives investors a hedge against these uncertainties. For property investors, receiving monthly rent payments from tenants provides a reliable income, especially if you're investing in tenanted apartment blocks. Investing for appreciation, on the other hand, often relies on asset values increasing over time. However, property prices or stock market valuations can fluctuate unpredictably, meaning there's no guarantee that an asset will appreciate in the way you expect. Cash flow investing, by contrast, focuses on real-world returns such as rent or dividends, which provide ongoing profits even if property prices are flat or market conditions are volatile. One of the smartest ways to build wealth is to use cash flow from investments to reinvest in more assets. This creates a compound effect, growing your portfolio and wealth at a faster pace. For property investors, the rental income generated by your properties can be used to acquire additional properties, which can in turn create more cash flow. This is a sustainable model for growth, as opposed to speculative investments where you're hoping for price appreciation to fuel wealth. Having a strong cash flow allows for more financial flexibility. You don't have to rely on selling assets or waiting for capital appreciation to realize profits. Whether it's dividend paying from stock or rental income from properties, cash flow enables investors to have access to liquidity without needing to dispose of assets. Now, let's go over a few ways to invest for cash flow, as there are several strategies you can pursue. Property investment in tenanted apartment blocks. In the UK, property remains one of the most effective ways to generate cash flow, especially if you invest in tenanted apartment blocks or multi-let properties. The key to success here is ensuring that the properties are already tenanted or have strong demand for renters, ensuring that you're receiving regular rent payments. Investing in apartment blocks can be particularly lucrative as they typically have a large rent roll spread across multiple tenants. While many people assume the initial capital outlay is higher than for a single family home, that's actually not the case. I go over this in detail in a free mini course which you can have access to via the link below. The advantage of investing in apartment blocks is that even if one or two tenants vacate, your cash flow is less likely to be significantly impacted. Additionally, apartment blocks are often located in areas with high rental demand, such as areas near universities, business hubs, or transport links, further increasing your chances of stable cash flow. Dividend stocks and funds. For those who prefer a less of a hands-on investment strategy, dividend-paying stocks or index funds can offer a passive income stream. Companies that regularly pay dividends, such as those in the FTSE 100 or established blue chip stocks, provide returns to investors on a quarterly or annual basis. These dividends can either be reinvested or used as a source of income, much like rental payments from property. However, dividend stocks may not provide the same level of predictability as property, as dividends can be reduced or eliminated during market downturns or poor company performance. Therefore, while they offer an alternative to property, they come with their own risks. Peer-to-peer lending or P2P lending platforms have gained traction in the UK as an alternative investment for generation of cash flow. P2P lending involves lending money to individuals or businesses via an online platform, and in return, investors receive regular interest payments. These platforms often offer higher returns than traditional savings accounts or bonds, but they can come with higher risks as borrowers may default on loans. Now, let's compare cash flow investing with investing for long-term appreciation, a strategy that is often seen as speculative. In the context of property, long-term appreciation refers to the potential for property values to rise over time, allowing investors to sell for a profit in the future. However, this approach has its risks. While appreciation-driven strategies may promise high returns, they are not guaranteed. Property prices can stagnate or even fall due to changes in the economy, interest rates, or local property market dynamics. In contrast, investing for cash flow provides more certainty as the focus is on generating income rather than hoping for prices to increase. Investors who rely on long-term appreciation often try to time the market. This can be very difficult to do successfully as market cycles are unpredictable. For example, someone may purchase a property hoping its value will increase, only for external factors such as a housing market downturn or changes to local infrastructure to affect the asset's value. Appreciation-focused investments are generally less liquid. If an investor wants to sell to realize a profit, they may need to wait for a buyer and negotiate the price that reflects the current market. In contrast, cash flow investments like rental properties provide consistent monthly income regardless of market conditions. To sum it up, investing for cash flow is a strategy that provides stability, security, and the opportunity to reinvest income to accelerate wealth growth. Whether through property investments like tenanted apartment blocks or passive income from dividend stocks, cash flow investing can help create a robust portfolio that withstands market volatility. While investing for long-term appreciation has its place, especially for those who are willing to wait and take on more risk, cash flow investments offer a tangible, immediate return on your investment. In the UK's dynamic property market, cash flow investing, particularly in tenanted apartment blocks, provides a smart, lower risk route to building wealth without the reliance on speculative price increases. In the end, the balance between cash flow and appreciation will depend on your financial goals, risk tolerance, and investment strategy. But for those looking for financial security and long-term growth, investing for cash flow is a proven, sustainable approach to wealth building. I hope you found this video useful, and as I mentioned, I've put together a free property investment training that you can sign up for using the link below. And as always, thank you for watching, and I appreciate you for being a subscriber. I'll see you on the next one.